So, what's up, guys, and welcome back to another episode. And we're going to talk about SPACs. And it stands for Special Purpose Acquisition Company. And it is really popular, for the last couple of years. A lot of people are trying to make money with it, using it, or trading it. So that's why we're going to explore how it works, what is it, and I'm going to use two Coach boxes here as an analogy. So these are my wife's favorite, and we'll explore that shortly. So let me just read off the definition for you here. So a SPAC is a shell company that goes on the stock market for the sole purpose of a reverse merger. So that is the official definition. So you might be wondering, what is a shell company? What is a reverse merger? And obviously, you know what a stock market is. So shell company, is that like the shell in Mario Kart? So when you're looking at a shell company, the easiest way to explain it is using shoeboxes. So here I have two shoeboxes from Coach, right? One of them is empty and one of them is not. When you're looking at a regular company going IPO, you are basically buying a share or buying a shoebox with some stuff in it. So here I'm going to open this shoebox. And you can see that there is a pair of beautiful shoes. So that's quite straightforward, right? That's what happens when you buy a regular business like Apple, Amazon, Google, because within the box, there's business operation, people are being hired, the company's making profit, it is growing. So that is the first box. That is quite straightforward. Now, when you're buying a special purpose acquisition company, the box, it's empty. There's nothing in it other than some paperwork. And it is basically a shell company, an empty box when it first goes public, and then they'll figure out something to put in there. And these companies, they're usually able to go IPO without going through the normal process by skipping a series of steps in terms of regulation. So it has no business or operation. Sometimes it's called a blank check company because investors are basically trusting its owner to make a good acquisition without knowing in advance which company it will be, like that blank shoebox I just showed you. Once the company merger is made, the SPAC's name is changed to the acquired company's name. So for example, one of the stocks that recently go IPO is Open Door Technologies. And before that, the symbol was IPOE. And then after it got public, it's OPEN, which is Open Door Technologies. So let's look at why companies want to go IPO through this SPAC method. Why wouldn't everyone just go IPO using the traditional IPO process that was set in place by SEC? Now, if you have been working in the accounting industry, you'll realize that IPO will usually take around 2 to 3 years to go through. It requires multiple years of audited financial statements. Usually they need to go back to re-audit some areas that are higher risk using a lower threshold. And there is a lot of documents a company needs to file before they can go IPO. And by using SPAC, they actually get to skip over all these steps. So in a sense, it's actually easier for a company to IPO through a SPAC because they skip a lot of paperwork. And this is usually popular for companies without a product or without a business model. And in a recent trend, you will see a lot of electric vehicle companies that go IPO when they haven't even made any revenue. Okay? So it's like going to IPO with a good idea. So let me show you what I mean. Now here, I have a shoebox. Now this box is beautiful. And when you buy a share of this box, what I'm going to do is I'm going to put an amazing, profitable company in here. Now right now, the company is not profitable, and I haven't put it in there yet. But if you buy this box, I will. So that's kind of how it works when people are buying SPACs. Now, after you buy a SPAC, you might end up with a company that is loss-making. and they don't fit the IPO criteria, but most people, they don't really understand the risk, so then they buy it because of the hype anyways. So once you put in, some good company or dog shit in there, then you're stuck with this company, and it is under the new symbol. So when you're looking at SPAC and why it is so popular nowadays, it's really because it's like an infinite money printing machine. All I gotta do is I will tell you, I'm a popular person and I sell you this box and I'm going to put a good company in there, and suddenly the stock price shoots up from $10 to $30 to $60 to $100, and that's basically free money to the sponsor or the existing shareholders that the company is not ready to go IPO yet, but they can still bring it to IPO through a SPAC and cash out on their investments. So let's look at the typical IPO requirements. So the first one is really pre-tax income of 10 million to 100 million in the last 3 years. So if you are thinking about a company that is making a loss, well, they're not going to fit this criteria. So loss-making company can't even go on IPO using the regular criteria. Global market capitalization, 500 million. Well, if I'm a company with just an idea and I don't even have a product yet, well, I'm not going to be able to go IPO regularly. The most recent 12 months revenue, 100 million. Again, if I'm a young tech startup with a lot of traction, but I don't have that much revenue, then I can't go IPO this way. Aggregated cash flow for the last 3 years, 25 million. Now, when you're looking at a loss-making company, sometimes they might be spending a ton of money on R&D. That is not even enough to cover their expenses. So the revenue is not up there. Maybe they don't have a product yet, or they're still ramping up their launched product, so they wouldn't have that much cash flow. And finally, total assets of 75 million. Now, when you're looking at something like a software development company or a software platform company, they might not have that many assets unless they start acquiring other software companies, because usually when you are building a platform, the company can choose to either expense all of the R&D costs, or they can choose to capitalize some of them. So that also depends on the treatment of the financial statements. So they might not meet that criteria as well. So here you can see there are some very strict rules in order for a company to go IPO under the normal route, which makes SPAC the more attractive option. So when you are looking at public companies, once they go public, there's going to be more filings. So this is actually one of my concerns related to SPACs, because you need to file 10Q on a quarterly basis. You need to file 10K, which is the annual report. And if you have seen some of the annual reports, you actually notice those are like 100, 200, or sometimes even 300 pages report that management needs to prepare. And if the company is relatively new, it's not that mature, then, well, they're going to have a lot of trouble preparing that in a very short window. And also, of course, Sarbanes-Oxley Act, which is a compliance related to accounting controls for the company. And the CEO and CFO also need to sign off on various documents. So when you think about all these regulations in place, going public is actually not that easy, which is why SPAC is so popular nowadays. Now, let's talk about 3 reasons why you should not invest in a SPAC. When a SPAC first go on the exchange, it has 2 years to find a target. So there's actually a ticking clock for a SPAC, because if they don't find a target within 2 years, then they'll get delisted. So they need to do a reverse merger within 2 years. And the longer the SPAC is in the market, the less time there is for the target to be compliant with the regulation. So here's what I mean. Let's say there's 2 years and the SPAC has been on the exchange for 1.5 years and it still couldn't find a target. The moment it merges with the target, it only has 6 months left for the target to be compliant with all the regulation that I mentioned earlier. So when you think about that, there is actually a time limit to a SPAC, and which makes it higher risk. Second, there's a reason why all these rigorous rules are in place, because when you're looking at all the income requirements, revenue requirements, asset requirements, it makes sure the company is in a relatively decent shape before it goes IPO. But now, private equity firms or funds are taking these private companies public, even though when they're not ready or they don't meet the SEC rules. Whether they are loss-making, they don't have enough assets, some ridiculous one, they don't even have a product. All they got is an idea, and they bring it public, and they raise a ton of cash, they cash out, and then the retail investors, me and you, will lose money if you're investing in these dog shits. So that's what we really want to avoid, is to invest in companies that have no product, no revenue, and loses a ton of money. And right now, in the news channel, you will find some of the SPACs that got IPO in the last 1 to 2 years have fraudulent claims. And the reason is because the founder promises the investors a lot of things they're going to be doing in the future, or the products they're going to launch, but turns out these claims are false, or they haven't proven it on a technical level. So, Eric, if it is so risky, why would anyone want to do a SPAC deal? Why would anyone want to invest in SPAC? And I think a lot of accountants are scratching their head when it comes to this question as well, because why would anyone want to invest in a poor company? Now, maybe there's just one reason. One is that you make a lot of money from this. And by talking about lot, I'm saying like a huge amount of money is being raised through SPACs. And here you can see the chart from Investopedia, money raised in US IPOs. And you can see the blank check IPO bar is off the chart in the latest year. So this is as of 2020, December 24th. So basically that is the latest year, not including 2021. And just by looking at the charts, kind of ballparking it, you can see that is approximately $70 billion. And what that really means is this. It means somebody took their shares that are worth maybe a penny or even less than a penny, and they IPO'd it through a SPAC for $10, $20, $30, so on and so forth. And then they cash it out at the top. So you can imagine how much money they're making. Like the shares are basically worth nothing when they first bought into the company. And IPO through a SPAC, you're cashing out to the retail investors. Then the retail investors are stuck with these bad companies and they lose money. But the sponsors, the original shareholders of these SPACs, will enjoy a brief moment of increase in stock price if they can create enough hype. So yes, a ton of money can be made in SPACs. So the question is, well, what are some of the mistakes you can avoid? How you can participate in this game to make money? Is it worth the risk for you to participate in this game? And what are some of the steps you can follow to reduce the risk as much as possible? So that's what the next couple of videos are going to be about. So if you're interested, then you can click subscribe, and I'll see you in the next video.